I'm Brandon Peak with Sherman Bridge Lending, and today's video is about hard money.
Okay, going through the presentation today, we're going to talk about hard money, how it's defined, how investors use hard money, the key terms and lingo, cash versus hard money versus conventional lending when it comes to financing these distressed properties. Hard money is defined as a specific type of asset-based loan financing through which a borrower receives funds secured by the value of the parcel of real estate. Hard money loans are typically issued by private investors or companies, such as Sherman Bridge Lending. Knowing how to use hard money is key, as hard money loans are designed to be used as temporary financing to acquire and rehabilitate distressed properties that will not qualify for traditional methods of financing. The goal of the borrower is either to sell the property for a profit after the rehabilitation has been completed, or refinance the property into a conventional loan and retain long-term cash flow. Investors prefer using hard money loans over other methods because of the product's speed, ease of use, and the added leverage attained by financing the entire rehabilitation cost of the project along with the purchase price. As with all collateralized loans, the size, rate, and length of hard money loan is determined by the volatility of the asset and the marketplace, as well as the financial standing of the borrower. Throughout the rest of this video, I'm going to be using some key terms or lingo. ARV being the first one, which stands for after repair value. This is the value of the property after it has been rehabbed. Loan to value is the LTV, the amount of money lent to the borrower based off the asset, and a lot of times those go together in the same sentence, so they correlate. Rate is a percentage charged in interest. Points is the cost of money. Refi is just short for refinance, typically a loan product to reduce your current interest rate. Normally it's long term. Out of pocket, the amount of skin in the game. Here is our cash versus hard money scenario. Let's say as an investor you have $150,000 to invest. And in our cash versus hard money scenario, we're going to compare an alike property. Actually, we're going to compare the same property. The ARV is going to be $100,000, with the purchase price being $50,000 and a rehab cost of $20,000. Now on the cash side, your total investment is going to be $70,000 with a gross potential profit of $30,000. Now on the hard money side, we lend up to 70% of the ARV, and your out-of-pocket cost is roughly half of the rehab. Here your rehab is $20,000, so your out-of-pocket cost is about $10,000. And you're still going to have your gross potential profit of $30,000. Now the important thing here is to look at your cash left to invest. If you had $150,000 to invest and you spent $70,000 on your first property, then you have $80,000 left to invest on another property. And that's the cash side. Now on the hard money side, if you had $150,000 and you spent about $10,000 to get into your first property, this means you would have about $140,000 left to invest. So your gross potential profit of 30 times more properties. Now on this cash versus hard money scenario, on the cash side, all you have really saved by paying all of the cash, the $70,000 in this total investment on this property, is you've saved the financing costs. Whereas on the hard money side, you paid the financing costs. And our typical investors are somewhere out of pocket between $10,000 and $15,000 per transaction.
To be able to contact me, here's my business card.